Welcome back to Investing Talk Podcast.
Today we're looking at MP Materials, the rare earth producer.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. And really, the core thing to grasp here, the thing that all the research points to is this massive fundamental shift MP Materials is attempting.
A massive shift. Okay, what do you mean by that?
Well, they're moving from being, just a low-value producer of rare earth concentrate.
So basically just digging rocks out of the ground.
Exactly. And they're trying to become this highly specialized, vertically integrated mine-to-magnet platform. This transformation is the whole story.
So our job here is to figure out how credible that pivot really is.
Yeah.
And I guess the starting point for that is, well, it's the ground they stand on.
It is. They own and operate the Mountain Pass facility, and this isn't just any mine. It's one of the highest grade rare earth deposits in the world outside of China. It's a generational asset, and it's right here in the U.S.
And the big ambition is to be the only fully integrated magnet supplier globally that's entirely within a friendly jurisdiction.
That geographic advantage is definitely unique. But the real strategic moat they're building is in that vertical integration plan itself.
Right, and we need to understand the stages here.
We do. They're moving beyond stage one, which is just digging up the low-margin concentrate. Now they're getting into stage two separation and refining, turning that raw stuff into usable oxides like NdPr.
And then the big one, stage three.
Stage three, manufacturing the finished rare earth permanent magnets.
So they're going from selling the raw commodity to selling the finished high-tech component that goes into an EV motor or a guided missile.
You've got it. It completely changes their margin structure. It's like if a coffee grower decided to also open up a global chain of cafes, they control the entire process.
And that's how they get away from the pricing volatility that's always been tied to China.
Precisely. If you control the whole supply chain, you have so much more control over your own pricing and volume.
Now, let's talk geopolitics, because that seems to be a huge part of this. You mentioned the plan includes a heavy rare earth refinery slated for around 2026. What exactly are heavy rare earths? Why are they so critical?
Heavy rare earths, or HREs, are elements like dysprosium and terbium. They're essential for giving magnets high performance, especially heat resistance.
Which you need for?
For anything high performance. Advanced defense systems, aerospace, high-end industrial uses, they're absolutely non-negotiable. And the global supply is, well, it's highly concentrated.
So if this refinery comes online in 2026 as planned,
it's designed to make MP Materials the only non-Chinese supplier of these critical heavy rare earths.
that's not just a business move. That's a national security move for the entire Western world.
It really is. It underpins the entire value of the company. But as you'd guess, building all of this infrastructure, it costs a fortune.
Which brings us to the money. How are they funding this?
That's the other unique part of the story. The level of government and blue chip commercial backing here is just unprecedented. It de-risks the whole capital investment phase.
Let's start with the government. The DoD, the Department of Defense, put in a massive $400 million preferred equity investment.
Right. And it's not a loan. It's an ownership stake.
Yeah.
That actually makes the U.S. government the company's single largest shareholder.
About a 15% stake, I
Yeah.
think. That's the ultimate insurance policy if you're worried about geopolitical risk.
And the deal itself is even better than just the dollar amount. It includes guaranteed price floors for NdPr.
So a safety net.
A huge safety net. The price floor is around $110 per kilogram, so it protects them if commodity prices get weak.
On top of that, there's an off-kick agreement, right?
Yeah.
For 100% of the output.
100% of the output from the new facilities for the defense sector, giving them clear revenue visibility all the way through 2026. They're building these plants already knowing who their customer is and the minimum price they'll get.
Wow. But it's not just a government project.
No, the commercial validation is also incredibly strong. Look at Apple. A $500 million procurement agreement with a $200 million prepayment.
Which is a huge vote of confidence. It tells the market that the tech is good enough for one of the most demanding customers in the world.
And that deal also focuses on recycling, which could be a whole other business line down the road.
Then you've got the EV angle covered too with General Motors.
Right. A major supply agreement for 1,000 tons of magnet supply annually. So you have defense, high-end electronics, and automotive all locked into long-term contracts.
And they have the cash to actually get it done. The balance sheet looks strong.
Very strong. Total assets around $3.8 billion. That gives them a ton of flexibility to fund the rest of the build-out in R&D.
Okay, so strategic moat, check. De-risked financing, check.
Yeah.
But we need to address the current numbers because right now the financials look pretty rough, which could be confusing.
That's the critical point. The story is entirely about the future. The near-term financials show stress because the company is actively sabotaging its old revenue stream to build a new, higher-margin one.
Sabotaging, that's a strong word. What do you mean?
Well, look at Q3 2025 revenue. It dropped by 50% year over year.
50%, wow.
But that wasn't a failure of demand. It was a deliberate choice. They cut back on selling low-margin concentrate to China. Instead of selling the raw rocks, they're keeping that material for their own new facilities.
The ones that aren't fully running yet.
Exactly. So they're starving their old low-margin business to feed their new high-margin future. The dip in revenue is the intentional cost of this transition.
They're in the investment phase, spending billions on CapEx.
Precisely. That leads to negative earnings per share, negative free cash flow right now. But we have to contrast that with the forecast, the investment then inflect story.
We need some leading indicators, though. How do we know this inflection is actually coming?
You look at the physical output. That's the key. NdPr oxide production surged 119% year over year in Q2 2025.
Almost 600 metric tons.
Right. That's inventory that's building up, just waiting to be turned into high-margin revenue as soon as those new facilities are fully online.
And what does that mean for future revenue projections? What's the scale of this inflection?
The scale is staggering. Analysts project revenue going from about $204 million in 2024 to an estimated $685 million in 2026.
So more than tripling in 2 years.
Exactly. And by 2029, those projections hit $1.42 billion. It's a massive growth story if it plays out.
And the bottom line, when do the earnings turn positive?
The consensus is pretty clear. They expect earnings per share to swing from negative in 2025 to solidly positive by 2026. That's when the operating leverage is supposed to kick in.
Explain operating leverage in this context.
It just means that once the huge fixed costs of building those facilities are paid for, the cost to produce each additional magnet drops dramatically.
Because they own the whole supply chain.
Right. So as revenue from the new high-margin magnets starts flowing, profitability should expand much, much faster.
Okay, so given that timeline, what are the key things to watch for in the next 3 to 6 months?
The most immediate catalyst is the Q4 2025 earnings release. That's expected in early February 2026.
And we're listening for commentary, not just the numbers.
All about the commentary. We need detailed progress reports on the new facilities and specific updates on how that government funding is being deployed.
And operationally, the big one is the Fort Worth magnet facility.
That's the trigger. It's expected to be commissioned by the end of 2025. Once that's online, they can start direct commercial sales of finished magnets to Apple, GM, and the DoD.
We should also keep an eye on institutional filings.
For sure. The 13F filings in January 2026 will be interesting. After all these big contracts were announced, institutional interest surged. Those filings will show us who's been buying in.
And what about their international plans?
The Saudi joint venture with Modon is scheduled for groundbreaking in December 2025. It shows they're thinking globally about diversifying the Western supply chain.
No. There's some speculative buzz too, right?
There is, but we have to be careful here. There's unconfirmed market chatter about new supply negotiations with another major U.S. electric vehicle producer, and maybe some accelerated procurement from the DoD.
But we have to stress, those are just rumors for now.
Yeah.
We stick to the confirmed facts.
Let's pivot to the market itself, because the stock has already reacted in a big way.
A huge way. It rallied up to 380% year-to-date in 2025. That's some serious momentum.
It is. And technically, it's trading well above its 50-day and 200-day moving averages, which just confirms that strong uptrend.
Sentiment seems overwhelmingly positive.
It is. A nearly unanimous bullish consensus from analysts. The average price target is in the high 70s, with some going as high as 112.
And that confidence is based on the future integrated model, not the current financials.
Absolutely. So if the upside is that big, we have to talk seriously about the risks. What's the number one risk here?
It has to be execution.
Hands down, execution risk. Building these complex facilities on time and on budget is extremely difficult. Any delay or cost overrun could really jeopardize that 2026 inflection point.
So that's the main hinge point. What else?
Well, there's always commodity price volatility, though the DoD price floor helps a lot with that. And there's customer concentration. They're relying heavily on the DoD, Apple, and GM.
Which are great customers to have, but you're still relying on just a few.
Exactly. And we should also address the insider sales we've seen from the CEO and CFO.
Right, that always raises questions.
It does. But it's important to put it in context. These sales came after a massive price run. So it's generally seen as just sensible portfolio diversification, not a lack of confidence. They both still hold significant stakes.
That's really important context.
So when you connect all these points, MP Materials is clearly more than just a mining stock. It's becoming a strategic asset for U.S. supply chain security.
The long-duration technology and defense story.
Exactly. But the entire investment thesis hinges on them successfully executing this mine-to-magnet vision over the next 18 to 24 months. If they hit those milestones, it could set up a really powerful earnings inflection beyond 2026.
The whole journey is so ambitious. If they actually pull this off, the question isn't just about their stock price, but whether the West's reliance on China for rare earths becomes a thing of the past. Are they just building a company, or are they redrawing a geopolitical map? That's something for you to think about.
If you found this discussion valuable, make sure you hit that subscribe button to catch our next analysis of the world of investing.